our national chartered tax advisors, Fiona Wheeler. It's always good to have lots of chartered tax advisors in the firm, CTAs, and have another fellow CTA on this call today. Fiona covers the country, but is based in our Manchester office, or at least lives in Manchester, so that's where she starts her life. But it's good to have them with me today, and it's good to have you here with us, and I hope you'll find what we're going to be saying is helpful. Just a note, first of all, on the Q&A, if you have any questions as we go through, please do put them into the Q&A panel on the right-hand side of your screen, where we say ask a question. If you are watching this on the catch-up afterwards, and I understand quite a few people do, please do send any questions through to me on my email, and we'll be pleased to try and answer those. If we can't get to your question today, we will answer it afterwards if you give us your email address, so that we then can follow that up. Just to confirm, recordings will be sent out with the slides, so you'll have everything after the event. Okay, so what are we going to try and cover? Our agenda. First of all, Fiona and I are going to talk about the new stealth tax regime. The phrase I've conjured here is the squeeze to raise tax, but not the rates, and something which developed a lot with the autumn statement. Then Rob Grove-Smith is going to talk about inheritance tax planning in that context, in the context of the stealth tax world we live in. And then Sarah will pick up estates and trust issues, some particular points of relevance in planning for executors and trustees. Just one quick word for the Law Society's IHT Planning Handbook. We didn't include the slide in our last webinar. The great news is, and I'm really, really grateful here to our succession of chancellors, and haven't there been a lot of them, but a succession of them for not actually changing the rates and the figures. So we've still got 325, 175 and so on. You know, those figures are still there in the book, and all the planning is basically still absolutely spot on. The only things that have changed since the book came out 2 years ago is the process in relation to applying for probate and the dreaded trust register. If you're interested, there is a review by the former chair of STEP England and Wales, Denise Molyneux, in the STEP Journal last June. And I hope if you look at it, you'll find that book helpful. It's written by 15 of us in Owen Mitchell, and it's designed for all who advise on inheritance tax. Okay, let's get started then with the new stealth tax regime, the squeeze to raise tax, but not the rates. And it's incredible to think that it's less than 6 months since the Liz Truss quasi-quaten combination and the dreaded mini budget. And so Jeremy Hunt came in to steady the ship. And what we've ended up with is a bit of a kind of hodgepodge, because we had an autumn statement in November, which was really a budget. It was a budget in all but name. Now we've got a spring budget in 2 weeks' time, and I do hope we'll get back to an autumn budget again, because, and we'll flag this up in a moment, you know, one of the problems with spring budgets is that you have legislation that follows from the policy announcements, and then we don't know what the law is going to be until after the tax year started. And we really need to get back to knowing, so that we can plan for our clients how they stand, what their tax position is going to be, what the law is before 6th of April hits us. So you know, that's the hope. But for the moment, we've got to make do with a spring budget and do what we can with it. But if we then go to the stealth tax Britain, as I call it, I've put here on this slide, we've developed it. It was already starting, but it's been taken much further by Jeremy Hunt last November. And we really need to think what this means for advising clients, because let's be clear, the revenue's aim is to substantially increase tax revenue without raising tax rates. It's what you might call sneaky, but it is designed to get as much squeeze as much as possible, you know, without actually appearing to increase the basic rates or the rates of anything. So we need to plan more carefully. We need to utilise exemptions, allowances, reliefs really carefully for clients. And there are lots of things that we can do, which I call here sensible mainstream tax planning. The mainstream system is all the more important to use effectively now. So let's have a look at this and see how that applies. But first of all, if I can just pick up a couple of points on 1.3, where there were two of the tax cuts that were in the dreaded disastrous budget last year, which did take effect. But there's 2 points to note on. One is that the national insurance contributions, the extra 1.25% stopped in November, but don't forget that the 1.25% on dividends continues, and that does have an impact on investments. And I think Fiona's going to comment on that in a moment. And then SDLT, when this came out, when these changes were made, it was announced as a permanent change. It's not a holiday, and all the conveyancers were grateful for that. But the reality is it is a holiday. It's only for a further 2 years and 1 month. Therefore, if people want to make the most of this, one of my concerns is that a lot of your clients might be thinking, well, let's wait for property prices to fall a bit, then we can help our children to get on the housing ladder. You know, if that's the scenario, we need to encourage people to get moving, because they need to be ready to get their transactions in place so that they can complete by 31st of March in 2 years' time. And that 2 years is going to run very fast. So, you know, just a kind of, you know, the time scale looks good at the moment, but it won't last for long. So over now to Fiona to talk about some income tax and CGT issues.
Great, thanks, John. So as John's already mentioned, the dividend rate has already increased, and unfortunately that's here to stay with us. But from the 6th of April, we're also going to see a decrease in the dividend allowance over the next couple of years. Therefore, we do need to be encouraging our clients to perhaps try and utilise these allowances while we have them, and sheltering from these higher dividend tax rates. Moving on to slide 1.5. So we're also going to see further income tax changes from the 6th of April, which sees the additional rate threshold reducing, with the high rate, basic rate thresholds and personal allowance being frozen for the next 5 years. So where we're going to potentially see an increase in wages, it's going to perhaps push many of our clients into a higher tax bracket that they're not used to being in. Moving to slide 1.6. Not only are more clients going to be caught by perhaps the additional rate tax, we are still going to see those whose income, which is between 100 and 125,000, having an effective rate of 60%. This may increase with the increase in wages to those people who are in this bracket, and therefore, again, we should be considering some planning to reduce this taxable income, such as making pension contributions or donations under a gift aid scheme, but also reviewing perhaps their investment income on the side. We move to 1.7. So moving on to the capital gains tax. Again, we're seeing allowances which are being cut from the 6th of April to less than half than what they currently are. And these allowances are not only being slashed for individuals, but also for the trustees. So even more care is now going to need to be taken when we're looking to realise gains for these clients after the 6th of April. But perhaps now we can review to ensure that their larger allowance is fully utilised before the end of the tax year. Moving to slide 1.8. It's vital that financial planners are included in any investment reviews due to these drastic changes in the annual exempt amount and dividend allowance and taxes. These changes may see an increase in individuals who need to not only report income tax, but perhaps capital gains tax in the 2HMRC, and perhaps be putting more people into the self-assessment regime. Moving on to slide 1.9. When we're reviewing investments, it may be a good time to also consider if income producing shares which are held outside of an ISA is still worth holding for an individual. Perhaps they need to just reconsider how their investments are held, perhaps consider investment bonds where we're able to take withdrawals tax-free within the limits. There's no dividend tax, but also this is outside of capital gains tax. And for those individuals who aren't maximising their ISAs, perhaps this is also a good time to try and review this. We'll move on to slide 1.10. Those of us who have clients who are married or in civil partnerships, this is a great time for them to perhaps review the need to restructure their investments. And they're able to do this by utilising a nil gain, nil loss transfer between spouses. We may use this to be able to maximise both annual exempt amounts, or assist with maximising one of the individual's ISA's allowances. or we could be looking to secure a better tax rate for one person within the couple, or avoid the need for one of them to be within the self-assessment system. Moving on to 1.11. So moving away from shares and then looking at other assets such as residential property. These should also be reviewed regularly and ensuring that those that can be considered a main residence, the correct elections are in place where applicable. Or those that don't qualify for a main residence, we should be reviewing the gains to look at what's accrued and having a think about when they may be realised so that we can plan ahead to mitigate against capital gains tax in the future. I'll pass back to John for slide 1.12.
Thank you, Fiona. Yes, the 1.12, I wanted to flag up a couple of things about the dear old Office for Tax Simplification. I cannot believe that the government actually feels that it's not necessary to have an OTS. It is one of the things that has produced some invaluable technical stuff, some changes that are not political, that are just about ways to simplify the system. And sadly, it's being wound up, and it is completing currently a review on the taxation of hybrid working. But I wanted to flag up particularly one particularly valuable change that they recommended, which was that there should be an extension of the current very limited provision for no gain, no loss transfers on a separation or divorce. Currently, we've got the disastrous position that if you should separate from your spouse, you've only got the year of the tax year of separation in which you can actually do those no gain, no loss transfers. The proposal which followed the OTS recommendation, and it was actually in the finance bill last year, was that there should be a year of separation and 3 more years. So it should give a really good time, because the reality is, divorces are not about tax planning, but the tax needs to follow the reality of what's happening on the ground and needs to give people time. And sometimes these things take time to sort out, don't they? So the frustration here is that it wasn't included, although it was in the Finance Bill, it wasn't in the Finance Act that was passed in January. My sources tell me that it is still intended to take effect from 6th of April. Now, I hope there might be something announced in the budget in 2 weeks' time. But if it's not, then we are relying upon legislation that may well be passed after 6th of April, taking effect from 6th of April. And that's, as I said earlier, most unsatisfactory. But just watch out for that. And in the meantime, for any clients going through a separation, the key thing is its disposals. So they may want to think about if delaying disposals into the new tax year in an appropriate case. Okay, then 1.13, we'd address the particular issue of the stealth tax, that is inheritance tax. This is where the classic case of a stealth tax. We have seen inheritance tax bans frozen for so long. The nil rate ban will have been frozen for 19 years by the time we get to April 2028. The residence nil rate ban will have had 7 years by then. We've got 5 more years of this freezing going on. So those figures, while it's good for books that are written, as I was saying earlier, and it's also, it helps us with the figures. It's a nice round £1 million for a couple. The reality is that those things are going to be more and more people caught by inheritance tax. The tapered loss over 2 million, that taper threshold, that's frozen likewise. So that when you get over that, you've got that marginal 60% tax rate on capital over the £2 million. If you've got clients who are at all blasé about inheritance tax, I think that those figures and that freezing illustrates the problem, and the end result is at the bottom of the slide. The OBR a few years ago estimated that over a 5-year period, the tax take from inheritance tax would go up by 1/3, from about 6 billion by over 2 billion pounds. And it now seems, from looking at the figures as how the tax is coming in, that property prices have gone up and the asset prices have gone up enough that actually that's an underestimate, and it may well be more than that. So, if anybody's blasé, that's a figure you may want to quote to illustrate the problem. And therefore, we come to the question of giving while living, which is a phrase that resonates for me, and I hope for many of you and your clients. So for clients to consider giving lifetime gifts, the reality is that many baby boomers, many in their 60s and 70s and so on, have done pretty well out of the system. So therefore, lifetime gifts are worth considering. So what we need to do now is to think a bit about some of the inheritance tax planning ideas. So Rob is now going to take us through those. Over to you, Rob. Thank you.
Thank you, John, and good morning, everyone. So the section of the presentation that I'm doing today, as John's just mentioned, is going to be focusing on inheritance tax planning, and particularly picking up on some of the themes which John has just highlighted around the baby boomer generation, arguably having come off quite lightly from the recent tax changes. And it might also be that they're at a point in their lives where they can start to think a bit more seriously about passing wealth on to younger generations. Maybe they've just paid off the mortgage, or perhaps they're downsizing and so releasing a significant chunk of liquid capital. Or it might just be that they're approaching retirement, so it's a logical time for them to start thinking about reorganising and reviewing finances. Whatever the reason, the message we want to get across is that they should seize the moment, try if they can to avoid this IHT stealth tax, and hopefully in the process try and help out us poor millennials feeling the brunt of high inflation, high mortgage rates and property prices, and particularly to try and do so before the CGT allowances are slashed, as they are about to be. Now, the first point I want to highlight on the slide there is that individuals really have to ensure now more than ever that they are maximising their use of the basic gifting allowances available to them. The normal expenditure from income exemption, I'm sure many of you are aware, allows clients to give away surplus income as regular gifts tax-free without the usual requirement to survive 7 years. But what often surprises us is how often high income clients are either unaware or just aren't making full use of that exemption. And at the end of the day, that's an exemption which allows individuals to avoid unrequired income pointlessly accruing to their estates, only to be taxed again at 40% on death. The marriage gift exemptions are another one which are often overlooked. So many of those baby boomers will probably be at a point in their lives where their children might be getting married. So that presents the perfect opportunity for them to make some larger tax-free gifts. And just remember that the allowances quoted on the slide there are on top of the usual £3,000 per year annual gifting allowance and are for each parent or grandparent, so they can often be doubled up. For business owners and farming families, they have some other considerations that they should be encouraged to take into account. They should be thinking about gifting shares or ownership of business and agricultural assets whilst the applicable IHT reliefs are still available. Now, that's obviously especially important if they expect a business or farm to be sold in the future. But even if they don't anticipate that, we don't know what's going to happen to these reliefs in the future. They may well become less generous. So our message is always that people should try and bank these reliefs whilst they can. In particular, people might want to be encouraged to think about gifting these types of assets to trusts, because that can be helpful in achieving IHT savings, even if clawback of the relief might apply in the future. Clawback of business and agricultural reliefs is probably too complex to cover within the time we've got today, but suffice to say that it's really important for individuals not just to take advice on whether to gift these assets, but also to take advice on the right method of gifting them to try and mitigate the potential impact of clawback of the reliefs if that arises in future. Now, moving on to my next slide, please. One scenario we're often presented with is how property rich but cash poor clients can achieve IHT savings through lifetime gifting when they need to continue to benefit from their property assets, either because they occupy them or because they rely on the rental income. The challenge being that if someone makes a gift of an asset but continues to benefit from it in any way, it will ordinarily be caught by the gift with reservation of benefit rules, and the gifted asset will continue to be treated as part of their estate for IHT purposes. And that's a fairly common problem, particularly in London and the South East, where clients who are otherwise maybe of fairly modest means have actually found themselves sitting on quite high value properties. The good news is there is a way out of this. There are some not widely known but important special exceptions to the gift with reservation of benefit rules, which apply if someone makes a gift of a part share of a property whilst retaining a share for themselves. In other words, they don't give away the whole thing. There are two categories of people who can benefit from this. Firstly, it's individuals who share occupation of their home with their children or other relatives. They can make an effective gift of a part share of the property to the cohabitees whilst continuing to occupy the property rent-free as long as they want to, as long as, and this is quite an important point, they have to share the running costs of the property with the cohabitees that they've gifted to. Secondly, individuals with rental properties can gift a share of those properties. It can even be a majority share, let's say 75, even 80%, to their chosen beneficiaries, but still continue to receive 100% of the rental income for themselves without triggering the gift with reservation of benefit rules. Now, there are some slight risks involved with this, and the capital gains tax implications, particularly with rental properties, do need careful consideration, particularly with the imminent reductions in the allowances. And I'm actually pushing through quite a few property gifts on this basis for clients before April to try and ensure that we benefit from the higher CGT exemptions as well as achieving the IHT savings. Finally, on lifetime gifting, I just want to give a quick reminder that, as John has alluded to earlier, the residence nil rate band does start tapering away once someone's estate goes over 2 million. And for individuals at risk of this happening, it's still worth them making lifetime gifts to reduce their estate value, even where they don't expect to survive 7 years. And that's just because lifetime gifts are not taken into account when calculating the estate value specifically for residence nil rate band tapering purposes, regardless of when those gifts were made. So someone with a £2.7 million estate, for example, who would be at risk of losing all of the residence nil rate band, could make a £700,000 deathbed gift even the day before they die, and that would successfully secure the whole RNRB for their estate. And just remember, as John mentioned earlier, that clients with 2 million plus estates are effectively paying a 60% marginal IHT rate on their assets that do exceed the £2 million mark, because they're losing allowance at the same time as they're paying IHT. Now, moving on to my next slide, please, and I want to talk about another critical feature of the lawyer's IHT planning toolkit, which is the client's will. Whilst many financially astute clients have at least some awareness of strategies for lifetime gifting, what surprises many people, including, it has to be said, some lawyers working in this field, is the extent of IHT mitigation which can be achieved just by having a carefully structured will. And one of the best tools that we have for IHT planning and wills is the nil rate band discretionary trust, under which a sum equivalent to the nil rate band is placed in a discretionary trust on the first death of a married couple. Now, these were very popular back in the days before nil rate bands could be transferred between spouses, but it's very common now for us to get clients coming to us saying that they've been told that their nil rate band discretionary trust is no longer any use, and in fact could be disadvantageous, and so should be taken out of their wills. Well, that might be true for some individuals, but for many others, especially those with estates likely to be subject to IHT, the nil rate band discretionary trust retains many advantages, and I've highlighted 5 on the slide there. Number 1 is preservation of the residence nil rate band, and as we've covered, married couples with estates over 2 million and who might be at risk of losing some or all of the residence nil rate band because of the tapering. For them, diverting assets into a discretionary trust on the first death results in a reduction in the value of the surviving spouse's estate inevitably, therefore maximising the chance of residence nil rate band being claimed on the second death. And remember that with a nil rate band discretionary trust, the surviving spouse can still benefit from the assets that are diverted to the trust on the first death if they need to. The second advantage applies specifically to individuals who might be in a second marriage, having been widowed from their first spouse. As you might know, the parties to the second marriage could then have up to 3 nil rate bands between them, possibly even 4 if both spouses happen to have previously been widowed. The problem they've got is that it's only ever possible to claim a maximum of 2 nil rate bands against a single estate. So if the couple just left their estates to each other on the first death, then when the second death comes around, there's only going to be 2 nil rate bands that could be claimed against the entire combined estate value, and the 1 or possibly 2 extra nil rate bands from their previous spouses would have been completely wasted. So diverting assets to the nil rate band discretionary trust on first death instead therefore ensures that they can both utilise all the nil rate bands potentially available to each of them. The third benefit I've noted there really applies to anyone whose estate is likely to be subject to IHT. If assets are going to be diverted to a nil rate band discretionary trust on the first death, and those assets appreciate in value before the second death comes around, you've effectively taken the gain in the value of the trust assets out of the survivor's estate for IHT purposes. And if there's a long gap between the first and the second deaths, that can bring some fairly significant IHT advantages. Advantage number 4 is probably one of my favourites actually, but also perhaps one of the least known advantages of a nil rate band discretionary trust. And this applies where the trustees choose to fund the trust using a share of the deceased's property. In these circumstances, HMRC actually allow the valuation of part shares in property to be discounted for IHT purposes. It's a 15% discount where the co-owner is in occupation of the property, or a 10% discount when they're not. And this allows trustees potentially to appropriate a share of the deceased property into the trust at a 15% reduction over its true pro rata value. In practice, that could allow the trustees to take a property share worth in real terms about $382,000 and transfer that share into the nil rate band discretionary trust, thereby keeping it out of the survivor's estate for IHT. But they would only have used up £325,000 of nil rate band to do so. And then there's a further advantage when the second death comes around, because the part share of property retained by the surviving spouse can then be discounted by 10% for IHT purposes. So just as an example, for clients with a property worth about £1 million, that combination of valuation discounts could achieve an IHT saving for them of about £48,000. And the advantage could actually be even greater than that if the property value had appreciated between the first and second death. For those of you who might be familiar with the related property rules, which cover valuation of assets jointly owned by spouses, you might be wondering why this particular aspect of planning is not caught by those rules. The answer is that the related property rules will not apply to the valuation of the property specifically for the purposes of appropriating it to the trust, because by the time that appropriation happens, the property actually will no longer be owned by 2 spouses, the marriage having ended upon the death of one of them. And finally on this slide, back to those business owners and farmers I mentioned earlier. If they can't or haven't given away all their business or agricultural assets in their lifetime, then the next best thing could be for them to add those IHT relief eligible assets onto a nil rate band discretionary trust in their will, rather than leaving those assets to their spouse outright. And that will ensure that if the business or farm is sold or otherwise loses eligibility for IHT relief after the first death, the value of those assets is not then going to be added to the surviving spouse's estate on second death, because the assets have already been transferred out of the estate to the trust free of IHT at a time when the relief still applied. Now, there might be some IHT to pay in the actual trust after the IHT reliefs have been lost, but that's likely to be significantly less than the IHT which would have been due if the assets had just remained in the survivor's estate. So that's the nil rate band discretionary trust, and as the slide says, most definitely not a defunct IHT planning tool. Now, moving on to the next slide, and I just have a few other more general IHT planning tips which individuals should be considering when writing their will. So for anyone who's intending to make a gift to charity, they should be checking whether the proposed charitable gifts will allow their estate to qualify for the reduced IHT rate of 36%, which applies when 10% of the taxable estate value has been left to charity. It can actually be the case sometimes that increasing the intended gifts to charity to meet the threshold for the reduced rate will also result in the non-charitable beneficiaries, in other words, family members, receiving more of the estate. That's just because the IHT rate applied to the whole estate has been reduced by 4%. And it's also worth mentioning that individuals are often labouring under the misapprehension that they've got to give 10% of their entire estate to charity for this to work. That's not the case. They only have to give 10% of the estate, which would otherwise be subject to IHT. In other words, 10% of the net estate value after available nil rate bans and reliefs have been deducted. And that actually makes it a lot easier to achieve this than many people realise. We also encourage clients to think long-term about their IHT planning, particularly when they have large estates. Think not just about their own IHT position, but also that of their children and grandchildren. For example, it might be sensible for them to leave their estate to their children and grandchildren on a discretionary trust rather than leaving the estate outright to them. That trust then provides a flexible pot of money the children can draw from only if and when needed, but if they don't need the funds, they will sit outside their estate for IHT purposes, avoiding a 40% IHT charge on their debts. Now, my next slide is about the use of trusts within wills, and where clients are using trusts within their wills for any reason, we need to ensure that they choose the appropriate trust structure carefully, because different trusts can have very different IHT implications for the client's estate and also for their intended beneficiaries. For example, in order for the resident's nil rate band to be claimed, the deceased's residence must be closely inherited by their direct descendants. Any property passing to a relevant property trust will not be deemed to have been closely inherited, even if the intended beneficiaries of the trust are the deceased descendants, and so it won't qualify for the resident's nil rate band. Relevant property trusts include full discretionary trusts, but you also need to bear in mind that they include many much simpler and more common arrangements, like an individual just leaving a share of their estate to a grandchild, subject to them attaining a particular age, such as 25. Where relevant property trusts are being used, consideration also needs to be given to the longer term IHT charges, which such trusts could be subject to on an ongoing basis once the individual has died and the trust has been set up. As you might know, it's potentially up to 6% IHT charges applied on every 10-year anniversary of the trust, depending on the total trust value. Where a client is instead considering gifting a beneficiary a life interest in their estate, it must be remembered that whilst there would be no ongoing IHT charges with this type of trust during the life tenant's lifetime, the value of the trust will be aggregated with the life tenant's estate on their death, and so potentially would be subject to a 40% IHT charge at that time. Now, that might not be a major issue where the life tenant is the deceased spouse, but it could be a serious problem if the life tenant was anyone else, particularly an unmarried partner, where granting them a life interest could very easily result in the client's assets being subject to a 40% IHT charge twice in short succession. So the pros and cons of different will trust arrangements from an IHT perspective need careful consideration on a bespoke basis. It should hopefully be clear from what I've said that the best approach to take will vary significantly depending on an individual client's circumstances and the assets involved, and there are non-tax related considerations to account for as well, so good professional advice on that is essential. So hopefully it's clear from everything I've just said just how critical a will is to someone's IHT planning strategy. And the best thing about using a will for IHT planning is that it doesn't require the individual to give up the benefit of any assets during their lifetime. So it's especially important for those clients who can't afford to make substantial lifetime gifts, and also for those without children or other descendants who can't benefit from the resident's nil rate band. Now, I've covered quite a few different things which individuals can consider to try and improve their own IHT position, but moving on to the next slide, what happens when clients die without having taken this kind of advice? It's always better for IHT planning to have been implemented before death, but nevertheless, all is not lost. Executors and trustees do have options for improving the IHT position of an estate post-death. Although for most of the post-death estate planning options, including much of what I'm about to discuss, this planning must be undertaken within 2 years to be effective for tax purposes. So it's important for executors to be encouraged to take prompt advice. Now, deeds of variation are the obvious post-death solution, and we can use them to do simple things, just like bypass a generation if a beneficiary feels they don't need their full inheritance. We can also use a deed of variation to rearrange the distribution of an estate to make optimum use of reliefs and exemptions, for example, to ensure the full residence nil rate band can be claimed. or to increase the benefits of charity or spouse exemptions. We can actually even use a deed of variation to allow a beneficiary who's received an outright gift to divert that inheritance to a discretionary trust to keep it out of their own estate for IHT, but they can still remain a beneficiary of that trust in case they do end up needing to draw on the inheritance in future. Now, that's not quite as good as the deceased having created the trust in their will, because when done by deed of variation, there are potentially some adverse income tax consequences for the beneficiary. But nevertheless, the deed of variation route is effective IHT planning when the deceased hasn't made the arrangements themselves. Now on to my final slide, and the other thing that we can do post-death is rearrange will trusts to address any tax issues arising from them. So for example, we could wind up a discretionary trust and distribute its assets to beneficiaries outright, or we could convert that discretionary trust into a life interest trust, which we might do sometimes to address any issues with securing the residence nil rate band, or to avoid those ongoing IHT charges I mentioned earlier, which might apply to a discretionary trust. We can also do the same thing where a beneficiary's inheritance is contingent on them attaining a certain age. We can actually advance the funds to them early, or perhaps advance them so that they'll be held on a life interest for that beneficiary instead. Where a life interest trust has been created by the deceased, but the life tenant feels they don't actually need the benefit of that trust, in those circumstances, the trustees can potentially bring that trust to an end early by advancing the trust assets to the ultimate beneficiaries of the trust, thereby avoiding the trust assets aggregating with the life tenant's estate on death for IHT purposes. Now, if that's done within the first 2 years by deed of variation, then there'll be no IHT consequences. But similarly, if the transfer of assets from the trust to the ultimate beneficiaries is done after 2 years, that will be treated as a potentially exempt transfer by the life tenant. And as long as they survive 7 years after that, again, there will be no IHT consequences to the advancement. So that was far from being an exhaustive list of the sort of post-death IHT planning that we can undertake for estates, but hopefully serves as an illustration that it's always worth beneficiaries seeking professional advice on means of optimising the IHT position following the death of a loved one. But what we do need to caveat that with saying is when anyone is undertaking any kind of post-death planning for IHT purposes, careful consideration does need to be given to the wider tax implications, especially capital gains tax. And this is where I'm going to pass you over to Sarah to hopefully expand a bit on that issue. Thank you.
Thanks, Rob. This final section of the webinar looks at CGT planning opportunities in estates and trusts in this stealth tax regime. Rob mentioned deeds of variation. Absolutely a useful post-death planning tool for IHT purposes. I'd like to build on that as they're also really useful for maximising CGT planning opportunities. When considering a deed of variation, you have a couple of options when it comes to CGT, and not everyone's aware of this. The new beneficiary can choose to take the asset at probate value, or they can take the asset at the current value and actually choose to crystallise the gain. Most often we would see people opt to take on the probate value, and sometimes there may actually be very little difference in the values. But given the imminent changes and specifically these reductions in the annual exempt amounts, a higher base cost, even if only slightly higher, may actually be beneficial for the new beneficiary. The example given in our slides is the settling of funds onto trust. The trust rate is going to drop to only £3,000 in April, so a higher base cost might make future planning for this trust much more cost effective. Looking at what personal representatives can do, moving on to 3.2, personal representatives can benefit from the deceased individual's annual exempt amount for up to 3 years after the date of death. Very often, these allowances are not maximised because assets end up being liquidated in one tax year as soon as the grant of probate is issued. Thinking ahead to the reductions that are coming in, it is going to become even more important to ensure that any available allowances are used. We should be speaking to the personal representatives to plan the liquidation of assets over multiple tax years if timescales and cash flow allow. We should also encourage personal representatives to involve the beneficiaries in these discussions. It might be that a beneficiary would actually like to retain an asset rather than receiving cash, thereby saving the estate a disposal. These conversations are always important and never more so than in the next 5 weeks, where we could do some planning to make sure that the larger allowances are maximised before 6th of April. Moving on to appropriations, these are one of my favourite topics, as they are such an underutilised tool in estate administration. So looking at slide 3.3, sorry. If the estate holds assets with gains, these assets could be appropriated to the beneficiaries before a sale so that their annual exempt amounts are used when the assets are sold. Depending on the number of beneficiaries and their personal tax rates, the estate could benefit from a lower rate of tax and multiple allowances. PRs can appropriate assets to individual beneficiaries, trusts, or charity beneficiaries, depending on the circumstances. It is often more advantageous for a gain to be crystallised in the estate rather than appropriating it to a trust due to the higher allowances, but it's worth being aware of this as an option. A really significant saving can be made where you have charitable beneficiaries, and it's almost always beneficial to appropriate assets pregnant with gains to charitable beneficiaries before they're liquidated. But note me saying almost always. As with most legal matters, there needs to be a cost-benefit analysis. Clients won't thank us for appropriating assets if the cost of the appropriation is greater than the tax saved. So, slide 3.4. The opposite approach is usually more appropriate when it comes to losses. If IHT has been paid on the estate, it's almost always best to crystallise the loss within the estate so that IHT loss relief can be claimed. Personal representatives need to be aware of the deadlines and the basis on which these claims are made, though. They only have 12 months to sell investments which have dropped in value if loss relief is to be claimed, and 4 years to dispose of land. Any claim will take account of both gains and losses in the relevant period, meaning that disposals should be made tactically to make the most of these reliefs. For example, if there are 2 investment portfolios, one which has made a loss, one which has made a gain in the first 12 months after the date of death, it could be very beneficial to time the disposals so that the portfolio which has made a loss is liquidated within the 12 months, meaning a loss relief claim for IHT can be made, while the portfolio which has made a gain is liquidated after that 12-month period, meaning that the gain does not reduce the value of the loss relief claim. I'm dealing with an estate at the moment with multiple properties where this timing is going to be absolutely crucial. I also wanted to highlight specifically with property that whereas we have this 4-year period for disposing of land and we can claim loss relief for IHT, that 4th year, if the property makes a gain in the 4th year, that is not part of the aggregated value for making the claim. Again, maybe a little known point, but something worth talking to clients about when planning these disposals. So slide 3.5. When thinking about CGT, we cannot ignore the largest relief available, which is of course PPR. Fiona and John have touched on this already. I wanted to just cover off how PPR might work in relation to estates and trusts. If at least one beneficiary in an estate satisfies the conditions, PPR might be available on a property held within the estate where there's been a gain since death. The conditions are more stringent for estates than trusts though. Not only must a beneficiary be occupying the property as their main residence both before and after the death, they must also have at least a 75% interest in this property. You can imagine in a situation where we have multiple children of a deceased that might be unlikely, and again careful planning in relation to the wills or considering deeds of variation might be important here. If we contrast that with trusts, the beneficiary only needs to have an entitlement to occupy the property under the trust. There is no minimum level of interest required. Slide 3.6. The key message for all clients is that they need to think strategically and get appropriate legal and financial advice. There are lots of opportunities to maximise the reliefs available, but there's also many traps. Planning ahead and getting advice in advance is going to be crucial over the next few years. Holdover, in particular, is another valuable tool, and one that I'll touch on in more detail in a moment. I just wanted to flag here that it needs to be used with care. Forward planning is essential, as holdover relief cannot be mixed with PPR. So if the trustees think that PPR may become available, perhaps through intending to grant a life interest to a beneficiary or restructuring the trust in some way, they shouldn't claim holdover relief now, as it could mean that the PPR claim is denied. The next slide is not one that I'm going to talk through in detail. It's really something that I think will be useful for you to refer back to after this event. Different types of trust are treated differently for CGT purposes. And again, when advising clients and looking at either situations they have set up already or their plans, we need to talk to them about this different treatment in case it influences the decisions. So 3.8. There are opportunities to maximise allowances and reliefs, not only for existing trusts and estates, but also on the creation of a new trust. Depending on the individual's personal tax position, and crucially here, their liquidity, the asset in question and the type of trust, to name but a few factors, it could be beneficial to trigger a disposal on the creation of a trust and pay the CGT now while the annual exempt amount is higher. This is particularly relevant if we're dealing with a husband and wife and there is a chance of us using 2 annual exemptions. For many people, though, they may not have the cash readily available to pay the CGT now, or they may think that there's a good chance that the asset will in fact fall in value in the future. In those circumstances, claiming holdover relief to defer the payment of CGT until the asset's disposed of by the trustees may actually be the better option. 3.9, a little bit more on holdover relief. I just wanted to flag here, this is not a reduction. Clients seem to really struggle with this idea. We talk to them about holdover relief. They expect to see something that's going to immediately save tax. It's not a reduction, it's a deferral. But if used properly, there are opportunities for direct CGT savings. The example I'd like to talk you through is where assets are distributed from a trust. The beneficiaries receiving those assets later sell them using their own CGT annual exemption. On that basis, the CGT liability will almost certainly be less than if the trust has made the disposal, simply due to the difference in annual exemptions. Individuals have a far greater annual exemption, even taking into account the upcoming reductions, than trusts. If there are multiple beneficiaries and the process is spread over a number of tax years, there's the potential for a substantial CGT saving. Under Section 260, holdover relief is available when an asset is disposed of, and there's an immediate charge to IHT as a result of this disposal. For example, a gift into trust or an asset leaving trust. The relief is available to prevent the gift from being subject to double taxation under both IHT and CGT. If the transfer is within the IHT nil rate band, there might not actually be any IHT to pay, but it's still possible to claim holdover relief and defer the payment of CGT because it is still a chargeable event. Again, this is often a point that clients really struggle to get their heads around. There are some traps though, as with anything, but with holdover relief in particular. Exits from a trust made in the first 3 months after the trust's 10-year anniversary are not subject to IHT, and therefore holdover relief cannot be claimed because this is not a chargeable event. If we look at circumstances where a gain is being held over and then the recipient says, "Thank you very much, I'm now going to leave the country. I'm going to become non-resident." If that happens within 6 years of the receiving the gift, HMRC can claw back the tax. Finally, the simplest and easiest trap, there's a deadline. There's a claim deadline of 4 years from the date of the gift. this often seems like a long time, and clients will say, oh, we'll think about it, we're not sure what daughter son's doing, they might be going abroad. All well and good, but that 4 years can pass really quickly, and we don't want to miss that deadline. So that's been a bit of a canter through some of the CGT tips, traps, opportunities. I'm going to hand back to John now to wrap up and talk us through some of the questions.
Thanks very much, Sarah. I hope that one of the things we've showed you here is that actually in relation to estates and trusts, while there is a lot of administration and kind of routine element, there's also often many planning elements that come up, and that's something that can get overlooked, and sometimes there are opportunities for estates and for trusts for proactive planning, and that you as advisors may be able to suggest to clients, actually there may be something you can do here, and that's something where we may be able to help with solutions to get a better result for an estate or a trust. So there's some really useful stuff in there. I hope you found that helpful. I've got a couple of questions now on nil rate band discretionary trusts, and I'm just going to pick up one of them first and then bring in Rob to deal with another. A very good question has said, if you have a nil rate band discretionary trust, do you not need to take care to ensure that you can still get the residence nil rate band on the second death, because you need to have at least 350,000 if you've got a double RNRB of assets that pass to descendants, and if it's in a trust, then that's not going to work. Now, obviously, one of the things you want to do on the death of a first spouse is to plan ahead and think about how it's going to work at the end of the day. And one of the things, therefore, that's vital to that is ensuring you've got sufficient in the name of the surviving spouse to take forward. Now, they may downsize at some point, and there's a specific relief for that if they do. But if they start with that, then you should be okay. The other thing to remember is that if you've got a nil rate band discretionary trust, it is flexible. You've got that 2-year period. You know, in the way that we've already touched on, you can rearrange that in the 2 years post-death, and therefore you've got the opportunity, if you need to, because the figures don't work out right, to change that and to make sure you've got sufficient at the end of the day for a double RNRB claim on the second death. So, really good question. I hope that makes sense. Can I then go on and post this question for Rob? If someone puts assets into a nil rate band discretionary trust on the first death, is there not a risk that the IHT will later have to be paid on the trust itself?
Yeah, thanks, John. It's a good question. There is a potential risk of that happening, but only if the trust remains in existence for more than 10 years. So if, for example, the first death occurs and the nil rate band discretionary trust is set up, if that trust is wound up before the first 10-year anniversary arises, there should be no IHT payable from that trust on the distribution of assets from it, regardless of how much the value of that trust is appreciated. So even if the trust is well over the nil rate band, if it's appointed out to a beneficiary in the first 10 years, after the first death, there should be no IHT. But if it does reach its first 10-year anniversary, it's likely that the IHT charges arising are not going to be that significant. The maximum rate is 6%, but in these scenarios, the actual rate charge is usually significantly less than that, and is unlikely to outweigh all the other IHT advantages that I went over in my presentation. So I think it's worth bearing in mind and being careful about, but it doesn't mean that it's not a viable option to consider. And again, as you said, it's something that the trustees can review and potentially do something with the trust, use the flexibility of a discretionary trust to adjust what might happen in future after the first death has actually happened.
And then the question goes on, and if the share of the property is put into the trust, doesn't it mean that the RNRB could be lost? I think we may have covered that already. But
I think you covered that in your answer, didn't you?
Yeah. Good. Well, it's always nice when you get similar questions, which, people have got the same issues arising. If anyone else has any questions, please do put them in. I've got a question here for you, Rob. The point about no gift with reservation, where there's a rental property gifted and you get 100% receipts, rental receipts. Why does this escape GWR? Surely this cannot come within the virtually excluded, so there's a clear benefit to the donor.
Yeah, well, another good question, and it is an exception which seems counterintuitive, but it's simply because I think it's section 102B of the Finance Act. Is it 86, John? You might have to that deals with gift with reservation of benefit, does just have a specific exception that doesn't apply the gift with reservation of benefit rules when someone gifts a part share of a property that they don't occupy. So it's just why it specifically only works for, well, for example, a rental property or any other property where the person making the gift doesn't actually live there. So yeah, it does seem a little bit odd, and sometimes we have to check it ourselves, but it is, the legislation does provide for that.
It's all about the drafting of the legislation, and it was the 86, as you say, the Finance Act in 86, which brought in the reservation of benefit rules. And the late great Chris Whitehouse was one of the great proponents or great people who flagged that up as a planning opportunity. Just one question here that was put in actually in advance in the booking. Don't forget that when we book with these webinars, you're able to put in a question, and so I can pick this one up now. My son and family live with me in my house. Does this reduce any tax liability? And I think the answer to that is Rob's already explained about gifting a share of a property and continuing to live there. I think the point is there you don't necessarily get an automatic tax reduction by having somebody living in the house with you, but it is an opportunity to gift a share of the property to them because they are living there, and therefore they can live there and share the accommodation with you, and that is also in section 102 of the Finance Act 86. So that was, you know, when reservation of benefit was brought in. So I think, you know, it is worth looking at that, and one of the things that the revenue often like to talk about is the fact that tax must reflect reality. And so there is something in their DOTAS guidance that says you can't give away too large a chunk. And they say, for example, it should be proportionate to the occupation. And I think this is the revenue having a go at the advisors. Not something we've done, but some people have tried to say you can give away 90% or a huge proportion of the property to a child who's, you know, adult child who's sharing the accommodation with you. In fact, you know, that clearly it isn't going to work according to the revenue's guidance in DOTAS guidance, but you need to look at the actual occupation. So in the example here, the son and family, if the son and family are living there and effectively there are, say, 5 of them and there's 2 of you, well, they might have, you know, more than a half because there's more than a half of the occupation of the house. You know, that's the sort of thing you can look at, but you need to plan very carefully and take proper advice on that, about how that's done, and then what situations, like if the children go up and move away or the son leaves, you know, what happens then? There's all those scenarios that need to be thought through. So that's you know, do watch that. One more question. Could continued occupation by the surviving spouse not be seen as an IPDI rather than a discretionary trust subject to relevant property charges? Rob or Sarah, one of you like to pick that up?
Sorry, I'm on mute. Yeah, I think the short answer is no. As long as it is clearly discretionary and the surviving spouse's continued occupation is purely at the trustee's discretion, then it won't be an IPDI. That's quite clear. That's the position with all kinds of discretionary trusts, that there's no interest in possession if the right to benefit from the trust is entirely at the trustee's discretion, which it would be with a no weight band discretionary trust.
Thank you. Well, it's just coming up to 11 o'clock, so we've completed our hour. I hope it's been helpful to you, and I hope we've answered some of your questions. But if you do have anything that we haven't answered, please do send us an email, and we'll try and follow that up very shortly. As I've said, we are going to send out to you some feedback forms and a copy of the slides, so you can see the details. There's a lot of detail in our slides, and I hope you'll find that helpful as an aid memoir. And so thank you very much for your time, ladies and gentlemen. It's really good to have you with us, and appreciate your interest, and hope we've been helpful. And just to say, we will be having another webinar in another 3 months or so, and we hope to see you then. But in the meantime, thank you very much, and all the very best in advising your clients in this stealth tax Britain. Thank you.